He's a CNN correspondent, Paul
Yeah, he's good to
LaMonica.
go live.
He's the digital correspondent at CNN Money. He joins our show every month or so to talk about the
Hey,
money.
Paul Monica.
Hey, Paul, we got you live here on Benzinga's
Great.
pre-market prep. How you doing today?
I'm good, thanks. How are you?
Good, good. Well, a veteran of the markets here. Just could you put this Amazon move in any kind of context or perspective so I can understand what the heck's going on with this thing?
It's phenomenal. I think the fact that they did report a profit really was a huge surprise. No one was expecting that, and we certainly have euphoria with a lot of these tech giants. We saw it with Netflix last week, Google as well, and now Amazon today. Apple seems to be the exception so far in not really blowing away Wall Street's estimates.
Paul, what are your thoughts here? Amazon now has a market cap bigger than Walmart. So when you put this in perspective,
Unbelievable.
I'm like, it almost seems irrational for me to think about it in that way. I mean, the multiple, you can't even look at it from an earnings perspective because obviously when you make 16 cents, and you annualize that, it's not even, from an EPS or from a PE multiples
Oh,
perspective, it just seems crazy. But I know, like, when the ball starts going one direction and the market starts going, it can last for a long, long time here. But when you really think about this, should this company be worth more than Walmart?
It's a very, very good question, and I think right now what comes into play is that people are looking at online commerce as not just obviously a passing fad and not just something that may be, sort of an ancillary part of retail. It is increasingly the way for people to shop as opposed to going to a big box store. Does that justify the valuation? Probably not, but the thing that I've been saying about Amazon for a while now is that can a company really be grossly overvalued for 20 years and then suddenly have some sort of spectacular fall from grace? I think Jeff Bezos deserves some credit here. Is the stock risky and perhaps way too pricey? Yes, but why would you bet against this guy when he's proven the bears wrong for 2 decades now?
Yeah, that's a great point there too. I mean, this has always had a high multiple. This has always had a very high valuation, and the stock has just
Yeah,
continued higher since it came out back in 1997. So
exactly. And I
incredible.
think Yeah, and I think what's going to happen today is a lot of analysts are going to rush to play catch up and bring those estimates higher. Now, there's really no way you can justify the valuation, of course, but I don't think it's fair to just say, well, they did a profit of 16 cents in the quarter, so you annualize that. That's not really, or 19 cents and annualize that. That's not really what you can do because analysts were already expecting, a 49-cent per share profit for this year, assuming 3 quarters of losses, because they're still expecting a big loss in the third quarter. So I mean, the fourth quarter is always big. So the 49 cents for 2015, that number is going to go up. Next year's estimates, I'm looking at about $2.87. That's going to go up. But again, even if it goes up to say, let's say people go crazy and decide, Amazon can make $5 next year. The stock is now at around 590, so we're still talking about a triple-digit multiple on 2016 estimates. But estimates are going to go up, and that's what Wall Street loves.
I'm not sure if you were covering stocks back in 99 or 2000, but like I was trading back in 99 and 2000. I can remember, and I actually took my CFA back in 1999, and there was and they changed the curriculum back just slightly in 1999 because they couldn't figure out, how to value these companies that had no earnings. So they came up with different formulas and they came up with all this different stuff on, how to value a company with no earnings. Well, 2002 came around after the tech crash. They took out that stuff out of the curriculum. They
did
said
they
the best
really?
way to value companies with zero earnings is zero. But this isn't the case with Amazon because they're obviously investing so much into growth here. But are we getting into a point where you feel like this is kind of like 1999, 2000 all over again in some of these stocks, where the euphoria is just setting in here, and multiples and valuation just doesn't matter?
It is a concern, and I think that definitely investors are kind of taking that attitude with something like Amazon and also Netflix. These are two companies that are both obviously investing pretty heavily in growth initiatives. But then you look at other big tech companies. I mean, Google is definitely not cheap, but it's not absurdly overvalued. I think
Right.
around like 20 or so times earnings estimates. Apple is dirt cheap when you throw in the cash. I mean, that is just an amazing bargain. I think no matter how you slice it. And then other tech companies, even Facebook. I mean, Facebook. If Facebook was Facebook back in 1999, with the same numbers, it probably would be trading at like 100 times earnings instead of just 40 or so. Which
Great
again, this
point.
isn't to say that any of these companies are cheap, but they are a lot cheaper. I think the risk that we're going to have is when all these unicorns start going public. I mean, Uber, Airbnb, Snapchat, a lot of potential, great promise. They're all fantastic companies, but they're already at these multi-billion, above 10, $20 billion valuations, and they're not even public yet.
Paul, shifting focus here on the other side of things, Biogen here disappoints the street. Has really been out of favor for quite some time here. We just harken back to that day that they announced a positive drug trial, went up and made that new all-time high. Now pulling back, but if you look at the ETF, I mean it's pulling back today. It's still relatively close to all-time highs. Do you think it eventually? I mean, this is the big dog in the index here. You think this is kind of a sign of things to come, or can the IBB, is this just an isolated incident with Biogen, or is it going to pull the rest of the sector down as well?
I think you do need to be careful. But biotechs always, to me, seem to be the type of companies that, unless you actually understand the science, that you really probably need to be very wary. That you just look at what's happening with Biogen. Biogen's actually still up year to date. They might lose all those gains today, but it just goes to show that there really is no way to know with absolute certainty what some of their high-profile drugs are going to be doing. Obviously you've got the guidance today coming down, concerns about their MS drugs. Still uncertain what's going to happen with their Alzheimer's drug. Obviously, them and Lilly have gotten a lot of attention for potentially developing some medications that could help with Alzheimer's. I just think that this is an area that it's not like online retail or other easier to understand businesses where you can say, I actually go to Amazon and I buy things. I can kind of understand the business model. If you don't understand the science, you're at a huge disadvantage, I think. It's not just about fundamentals of earnings and revenue. There's a lot more here.
Paul, we've been trying to pound through all these earnings, and we're in earnings season. It's so difficult to cover them all on our show. But we haven't talked about Pandora here yet, and Pandora's earnings report. And they did report 5 cents versus adjusted 2-cent estimates, and they did beat on the revenue line too at 285 million versus 283 million. We are seeing a significant pop in Pandora Media here this morning. This is popping back, and this is a stock that has been out of favor for the last couple of months, getting a nice relief pop here on Pandora. What did you think of their quarter?
The numbers looked really good. It's going to be interesting to see just how Pandora fares against increased competition. But that's been the concern for a long time now, and Pandora has so far shown that it can withstand some of these pressures. Obviously, there's Spotify. Pandora will tell you that what they do in Spotify are not really similar, and I think there is some truth to that, since Spotify really is more about finding specific artists and songs, and Pandora is more like a real radio station. A lot of it is the roll of the dice in terms of what song you're going to be getting next. You do have Apple Music now, and people were worried about Apple and the free trials. Is that going to hurt Pandora? But Pandora seems to be a company that is a bit of a survivor. Of course, the stock is hated. It's heavily shorted, so any big rally you have to take with some grains of salt, because I'm sure there's a bit of a short squeeze going on. But I admire that Pandora is hanging in there when everyone has been predicting their demise for a long time.
You mentioned that you thought Apple was cheap, and I think of during the earnings season here so far, this stock has been the biggest disappointment for investors. Of course, you had a 13-point run going into the earnings here. what didn't the street like? Are they overdoing the fact? Maybe a little bit of the dollar hurting them a little bit. But everything seemed from the rest of the stuff on the conference call. Inventories are down. They're gearing up for iPhone 6s. I also saw another percentage that only like 25% of the people that are going to have upgraded to the new phone. What did the street like about Apple's report?
I think that really, when it comes down to it with Apple, the great thing about Apple is also its biggest risk, which is it is so dependent on the iPhone, and that's what happened with the quarterly results. I mean, they quote unquote only sold 47.5 million iPhones in the quarter, and people are freaking out because they should have sold 49. That's a little insane, if you ask me, to punish the stock for a miss like that when 47.5 million phones in a quarter, several quarters after the 6 came out, is just a phenomenal number for them to put up. But I think it is fair to wonder if Apple is becoming sort of a one-trick pony. If it is, that pony's American Pharoah, though, so it's a good one to bet on. But you do have China as a concern as well. And I think some people may have been over-dramatizing the big sequential drop in the sales in China for Apple, and maybe kind of trying to suggest that, oh, look at all the market volatility in China. Their economy may be slowing a lot more drastically. They've got many competitors as well, Xiaomi being first and foremost. So I think there's some degree of concern that Apple is becoming more reliant on China as well for iPhone sales, and that is a market that's now fraught with risk. And I get that. I think there's some validity to that.
And I agree here. I think Apple, they really need to get started here because it's more like a cash cow here now. I mean, the valuation, it's trading like a cash cow. The iPhone market is the majority of their revenue here. They need that next blockbuster product here, and I don't know if it's going to be the watch. They talked before about Apple TV, but that doesn't seem to get much media attention here at all anymore. Do they have anything else, do you think, in the works here? Like, obviously we don't know, but they got a lot of cash there. They must have some other big ideas, don't they, over there at Apple?
Everyone is speculating that it's the car. We have a great story that was done by one of my colleagues on CNNMoney earlier this week, Jose Palgieri, where he looked at some of the high-profile hires that they've made in the automotive industry. And even though Apple has been very adamant that they're not necessarily doing anything with a car right now, I think that is probably something that people are looking at. The TV set rumors, I think, have finally been put to rest. I mean, Apple's TV aspirations are probably really going to be more with the existing Apple TV box that they have, and not probably doing a full-blown, flat-screen Apple-connected TV. So the car is probably where people are looking at. And again, with the watch, I don't know if the watch is ever going to be the type of product that the phone is, but people that are down on Apple because of supposed concerns about watch sales, they do have to remember that with any first iteration of a product, you can't judge it based on that. I mean, remember the first iPod with a click wheel? I mean, no one in their right mind would say that the first iPod was this revolutionary device, but they obviously got better and better. And I think you're probably going to see that with the watch.
Paul, before we let you go, there's been some consolidation in the healthcare industry. You had the Humana and the Aetna, and now the Cigna and the Anthem. And if you're buying something for a takeover and it actually gets taken over, you're a little bit disappointed here. I know Dennis played the Humana successfully. What is it? Do you think it's just an antitrust, situation? It's keeping these premium. I mean, there's huge discounts to where the takeout price is.
Well, yes and no. I mean, a company like Cigna, the premium to where it was yesterday is not that significant. But Cigna is a stock that I'm checking now, has gone up 50% this year. Obviously, the rumors have been around for a pretty long time. You look at something like Humana. Humana is up, and I'm sure it's another pretty large, 29, almost 30% this year. These companies that are getting taken out, it's not exactly a secret. It's not like we're Verizon and AOL that kind of sort of came out of nowhere. I mean, there had been rumors for a few years that might happen, but when it actually happened, people were like, oh, wow, that happened. This is no secret. So, people that have been in these stocks for a couple of months should be happy. If you just bought it yesterday because you read a headline in the Wall Street Journal, sorry that you're only getting a tiny premium.
Just one more stock I want you to get your take on, kind of take it off on the Apple Watch. Fitbit, it's had the IPO. It's been a pretty good performer so far. Kind of just hanging out near the highs of the move here. Any insight on Fitbit?
Fitbit's a company that we're going to see just how strong they are when they report earnings in early August, but it is a company that's profitable, so that is a huge plus. The revenues are growing pretty dramatically. It's very similar to GoPro, not in the sense that they make the same things. I mean, I think some people have been kind of lumping them together as a trade just because they're both in a hot gadget market. But I think Fitbit, like GoPro, has carved out a bit of a niche. You have to worry about competition. Of course, there's that company with a fruity name in Cupertino, California that we discussed earlier. But I think Fitbit and GoPro probably can stick around as long as they remain focused and don't get overly aggressive. I mean, Fitbit's not going to be the next Apple, but that's not exactly a problem.
We've been on the line with Paul LaMonica. He's a digital correspondent at CNNMoney. He writes daily about the markets, the economy, and technology. You can follow Paul on Twitter at LaMonica.Buzz. Paul, a pleasure as always. Thanks for joining us. Have a great weekend.
Thank you. You too. Appreciate it.
We'll get you on again soon.
Thanks, Paul.
Thanks a lot. Bye.